Are you wondering whether or not the Trump tax cuts from 2017 are going to be extended? And if so, how that affects your hard-earned retirement dollars? Well, stay tuned. This week's episode of the Retirement Income Source, where it's all about the income. Welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host Sarah Samuels. And today we're going to talk about the Trump tax cuts for 2017, many of which are going to expire at the end of 2025, and what you need to know when planning for your own retirement, whether you're retired or thinking about retiring in the next few years. And speaking about retirement, we had to retire our live show last week. We actually had to go back and play a rerun because my lovely co-host over here wasn't feeling so well. You were down for the count. But it looks like you're no worse for the wear. You're back in shape, feeling good?
I am, Dave. I'm feeling a lot better, and it's great to be here, of course, with you and with all of our listeners out there. You know, it's that time of year. There's a lot of different bugs going around. Sometimes when you get sick, you just go down hard. But I'm glad to be back here, Dave, and especially talking about this important topic because everyone wants to know how can they really maximize their income and minimize their taxes, especially in retirement.
And, you know, I think most people believe that they will extend most, if not all, of the features of that tax act. Primarily, and a lot of people are upset about, some people are happy, some people are upset about the way DOGE is going and trying to cut expenses. But I think, the more expenses that can be cut, the greater chance we have of having a vote that says, hey, yeah, let's extend this tax cut even further. So that's all good news because it took the 15% bracket down to 12%. And every other bracket came down at least 2 or 3 percentage points. So that means that for your average retiree, you're saving a good amount of money all in. So it's all good news. It seems likely, but let's get into it because there's a lot about how, a lot of people want to know about how it really affects them more specifically.
Oh, yeah, absolutely. Especially with the tax cuts you mentioned, it's expiring at the end of the year. The corporate tax rate, the standard deduction, the child tax credit would all be expiring at the end of the year. But I'm sure our listeners, they probably want to know, Dave, another way that they can maybe get your book, your Amazon bestseller, named for our show, The Retirement Income Source, where it's all about the income. So we want to invite our listeners, if you have a question about taxes or maybe a policy that you've seen and you want to ask Dave, we invite you to call the Ask Dave hotline. That number is 800-822-1111 and leave us your name and number and a voicemail with a question for the show. And if we use your question on the show, we'll get you a copy of Dave's book for free. Let's get into our Ask Dave question, which comes from Jonathan in Connecticut. Jonathan agrees with you, Dave. He says, I don't think this Trump administration is really going to mess with Social Security benefits and benefits for older folks. But do you think they will change ultimately how those benefits are taxed?
All right, Jonathan. Well, let's take a minute and let's explore how benefits are taxed right now with Social Security. And it's at a pretty low income amount. So there's something called a provisional income, which is actually a term in the IRS code, which takes your adjusted gross income and adds to it half of your Social Security and all of your tax-free municipal bond interest. So even though the municipal bond interest in and of itself may be tax-free, it gets added into this equation. And if that number exceeds $25,000 for single taxpayers and $32,000 for married taxpayers, then part of your Social Security benefits are taxed, up to as much as 85%. So if you think about it, if your Social Security benefits are $2,000 a month, half of that is $12,000, which means if you're single, you can only have another $13,000 of income before that Social Security becomes or starts to become taxed. And again, as much as 85% of that benefit can be taxed at the high end. Now, it doesn't mean you're going to pay 85% tax. That doesn't mean that you get $1 from Social Security and most of it goes to the government, but it means that 85% of that benefit might have to be claimed as taxable income on your tax return. So the problem with that, Jonathan, is that a lot of people think, gee, the highest tax bracket right now for individuals is 37%, and that's really not true because for certain retired taxpayers, you might be in a lower tax bracket on paper, but if you're in that window where every dollar that you earn causes $1.50 or $1.85 to be taxable because of Social Security, then you might find yourself in a higher marginal bracket than just that 37%. So no, I don't think the administration is going to tinker with the taxation on that. I doubt that they will, but I also doubt that it's going to get any better too. So either way, Jonathan, you're going to want to plan for when to take Social Security and how to do it in the most tax effective way.
Jonathan, thank you so much for calling the Ask Dave hotline. We'll make sure you get a copy of Dave's book, The Retirement Income Source, The Ultimate Guide to Eternal Income. And of course, we want to ask all of our listeners to please call that hotline. That phone number is 800-822-1111. Leave us your name, your number, and a voicemail with your question. And if we use it on the show, we'll get you a copy of Dave's book. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about Congress is looking to reauthorize the Tax Cut and Jobs Act, the Trump tax cut from his first term, as key parts of it are set to expire at the end of this year. But our listeners want to know, well, how is this going to affect me or potentially affect me, especially if you're nearing retirement? So, Dave, you answered a really great question about Social Security and analyzing the way the different parts of it break down on the ways that it's taxed. So can you tell our listeners, like, what are some ways that they can make sure that they don't pay too much tax?
That's a great question. And it depends on people's situation. Everyone's different. But Social Security kicking in is part of the problem. The other part of the problem is that a few years later, required minimum distributions kick in, where you have to start taking forced distributions from your IRAs and your 401ks. And that becomes taxable. So you might be thinking, okay, I'm good for a while, and then all of a sudden you get to a certain age and you're not so good anymore. So some of the strategies for some people, Sarah, it comes to taking Social Security later and pulling money out of your IRAs at a younger age, so that by the time you take Social Security, maybe you have less money left in there, and as a result you get more of your Social Security benefits tax-free. In other cases, it's saving taxes on your Social Security benefits early on. So it's spending your non-IRA accounts first and letting your IRA accounts accrue to later. And that's maybe for people who are collecting Social Security at a younger age. So I think the first thing that has to happen is people need to look and say, okay, based upon my life expectancy, my health, my longevity, when should I take Social Security? Should I, based upon all the different factors that help you determine how to maximize your benefits, should I start taking it at the earliest time at age 62? Should I start taking it at the latest time, age 70, or somewhere in the middle? Then when you factor in your pension income and income from other sources, now you can start to build a plan around, the order in which you take income from various buckets of money, and therefore also start to plan around how you can hopefully pay as little as possible on Social Security.
Absolutely. Well, a lot of people might be thinking, well, how much, Dave? How much could I save maybe over the course of my lifetime if I delay my benefits? Well, we're going to answer that question, and you might be surprised at how much you can save if you delay those Social Security benefits. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income. We appreciate you spending some time here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we are talking about if Congress will renew President Trump's tax cuts from his first term and ultimately how that will affect retirees. And we know that most people want these tax cuts to be renewed, Dave. They like them. They feel favorably about them.
It's interesting. A lot of people accuse the president of trying to create tax cuts for, his billionaire crony friends, as they like to say. Yeah. But the reality is, in some ways, retirees, benefited the most in this. I mean, so first of all, as I indicated in the last segment of the show, if we just, if the average tax bracket went down, 3% from 15 to 12 or 39.6 to 37, that means if you're retired, you're making $50,000 a year. It means you save $1,500 of tax. If you're making $100,000 a year, it means you save $3,000 of tax. But with retirees, it's even more extreme, because they increase the standard deductions. And when people retire, they have fewer deductions because oftentimes they're not given as much money to charity. They paid off their mortgage. They don't have the mortgage deduction anymore. Now with the SALT limits, they can't deduct state and local income taxes and all that. So as a result, the itemized deductions tend to go away. And one of the things the Trump tax law did do was increase standard deductions. So if you're still making a lot of money, you're probably still going to itemize. You have enough deductions where the increased standard deduction doesn't help you. Retirees, I find, tend to not take itemized deductions anymore. So they're saving even more than that $1,500 or $3,000 a year, and that's good.
That's huge, yeah, especially when you're on more of a controlled income, in
That's right.
retirement.
Fixed budget.
Exactly. And we want to encourage all of our listeners, if you have a question maybe about the Trump's tax cuts or taxes in retirement, we'd love to hear from you. Please give us a call on the Ask Dave hotline. That phone number is 800-822-1111. Leave us your name and your voicemail and a message with a question for the show. And if we use your question on the show, we'll make sure you get a free copy of Dave's book, The Retirement Income Source, The Ultimate Guide to Eternal Income. And I want to thank you to Rose in Connecticut, who called us and left her voicemail. Rose says, I'm really worried about paying a premium on Medicare if I have a higher income in retirement. How can I avoid this?
Okay, Rose, I think what you're talking about is our great Aunt Irma, right? We have the great Uncle Sam, who's really not our great uncle. He just takes money from us. And the great Aunt Irma that also takes money from us. And what IRMA stands for, it's an acronym, of course, and it stands for Income-Related Monthly Adjustment. And essentially what happens is I think you might be aware, Rose, is that as your income gets over certain thresholds, the cost for your Medicare Part B and Part D starts to increase. And it could be significant. It could be several $100s a month. For single taxpayers, that increase starts at $106,000 of income. And again, they're using that modified income that we talked about when calculating taxes on Social Security, right? And also, the same thing is true with married couples, only it's double that. It's $212,000 of income. So here's how I'd like to look at it. Let's say, Rose, you're single, right? If your income's $200,000 a year, well, you're far enough over the limit that, who cares? You have to pay a little bit more every month. But the problem is when you start to get in and you're maybe at $120,000, people say, well, gosh, if I could just stay under 106, then I don't have to pay taxes on that. So again, another reason to plan accordingly is because of IRMA taxation. So again, when you start with saying, gee, what makes the most sense for taking Social Security for me? Should I take it early? Should I take it late? Based upon a whole bunch of factors, your own health, longevity in your family, whether you're married to somebody younger, older, that person's health, that person's longevity. When you start to look at all those factors and you decide when to take Social Security, then you've got to figure out, okay, how much your required minimum distributions are likely to be starting at age 73, along with how much income you need earlier in your retirement years, assuming you retire before age 73. And then start to piece that puzzle together and look at that provisional income calculation and determine how it affects your Social Security and determine how it affects IRMA, determine how it affects taxation or increased premium on Medicare Part B and Part D.
And Rose, thank you so much for calling the Ask Dave hotline and leaving us a voicemail. That phone number is 800, that's 800-822-1111. Leave us your name and your message with a brief voicemail, your question for the show. And if Dave answers your question, we'll make sure you get a free copy of his Amazon bestseller, The Retirement Income Source, The Ultimate Guide to Eternal Income. You're listening to The Retirement Income Source, where it's all about the income. I'm Sarah Samuels, here with David Scranton, and we are talking about ways that you can make sure you keep your income in retirement and avoid paying too much in taxes, especially in light of Congress taking a look at the Trump's tax cuts from his first term and potentially reauthorizing those and that effect on retirees.
Mm-hmm. Yeah, it's something that is likely to go through right now with majority, in the House and the Senate, likely to go through. I know they want it to go through, and they might even try to cut brackets a little bit more. We don't know yet. But, bottom line is when you're retired, especially when you're working, but also when you're retired, a penny saved is a penny earned. So sometimes people think about, gosh, I need more income in retirement. Well, maybe, but what if you get your debt paid off in retirement? Then maybe a certain amount of income will go that much further because you don't have any debt. Or if you can save taxes, then maybe $1 of income will go that much further. So again, it's not just a question of getting more income. It's a question of saving defensively in these other areas. Some of the areas we talked about today, taxation on Social Security, taxation on, or increase in premium due to IRMA on your Medicare Part B and Part D.
Yep. But no matter what you do to save, Dave, no matter what, everyone eventually has to pay that uncle you mentioned, right? Uncle Sam, in the form of required minimum distributions, which kick in for most people at 73.
That's right. They kick in at age 73. And that's where a lot of planning really comes in, Sarah. So we talk about saving taxes, right, in retirement. And what's interesting is, everybody knows to be diversified, right? Even at your age, you're young enough where you could take bigger risks. But step one is diversify, right? Don't put all your money in one stock.
Right.
Yeah, you might get lucky where it was NVIDIA and you just made a lot of money, or you might get unlucky and it's one of many others that did poorly.
Right. You lose everything, or
That's
most
right.
of it, yeah.
So you want to diversify. We also want to diversify when it comes to taxes. And most people don't think about that. When you're working, you want to save taxes. So you want to, you put a lot of money in your 401k before tax and you accumulate. And that's great because you're paying less tax along the way. But what you have to realize is ultimately you're creating a bit of a tax time bomb for yourself, where now when you retire, every dollar of income that you take is taxed. You don't have any tax-free income. You don't have any accounts that are currently taxable. So one of the major strategies for people to save taxes in retirement is to diversify the taxation of their investments. And the younger you can start, the better off you are. But all is not lost for those who are nearing retirement or in retirement who haven't done it yet.
Yeah. Well, we're going to talk about some ways that you can actually diversify the way that you are being taxed, especially those folks that are right in our audience we're talking to here, the pre-retirees and those in retirement. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about the income. Thanks for listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we have been talking about ways that you can avoid paying too much tax or getting hit with that tax time bomb, especially as you're heading into retirement or even if you've already retired. So, Dave, really one of the big issues is if people are lopsided, right, when it comes to the ways that their investments are going to be taxed. So can you explain maybe the different buckets of investments and how they are all taxed?
Sure. I mean, generally speaking, there's three buckets, right? There's your taxable investment that you pay tax on each and every year. So you might pay tax on dividends from stocks or mutual funds or interest on a bank account or bank CD. If they're stocks and you go to sell them, you might have a capital gains tax to pay at the end, but you paid some taxes along the way. And capital gains tax is at a lower rate, so it's considered to be more favorable. But then you have your tax-deferred bucket, and your tax-deferred bucket is where people often get lopsided, right? It's the 401k money where you've tried to put all pre-tax dollars in. Or it's your traditional IRA money or things like that. That's your tax-deferred bucket where when you go to take withdrawals in retirement, most or all of it is taxed as ordinary income, not capital gains.
Yeah, and that's where the time bomb can be.
That's where the time bomb can be, correct. And then you've got your tax-free bucket. Your tax-free bucket are things like Roth IRAs, where you put after-tax dollars in, but the money comes out tax-free. So as people often say, instead of paying tax, instead of getting a tax-free seed, but having to pay tax on the entire harvest, like a 401k, in this case, you pay tax on the seed, but the harvest is tax-free. All the withdrawals from the Roth IRA are tax-free. Another tax-free bucket is 529 tuition plans if you're saving for college for a grandchild. So again, the key is to be balanced, and oftentimes I find that people are lopsided one way or another, most often toward the tax-deferred side.
And that could be a huge issue, especially for people that are heading into retirement.
Yeah.
If you have questions about ways that you can make sure you're not overpaying in taxes, that you're maximizing things like your Social Security benefits, I encourage you to call in to the Ask Dave hotline. That phone number is 800-822-1111 and leave us a message with your name, your phone number, and a voicemail. And if we use your question on the show, we'll make sure to send you a free copy of Dave's book, Retirement Income Source, the ultimate guide to eternal income. And our next question comes from Margaret in Delaware. So Margaret, thank you so much for calling our hotline. Margaret says, my husband and I retired last year, but we're realizing that all of our money is in our 401ks and IRA accounts. Everything is taxable. So whenever we withdraw money, we get taxed on it. Dave, what can we do?
All right, Margaret. Well, it's interesting. If you had 10 years of working career ahead of you, it would be a little bit easier because you just stop putting money in the 401k or put just enough to get the match from your company. And then you start putting money into Roth IRAs and you start putting money into taxable accounts. And in the last few years of your work life, you can somewhat balance it out. Now, what you're saying, Margaret, is you've gone past that, right? So that's not an opportunity for you anymore. So how might you do it? Well, the only real answer is through Roth IRA conversions. Now, the good news about a Roth IRA conversion is after you do it, withdrawals down the road from that Roth IRA can be taken completely tax-free, providing you follow certain stipulations. The bad news, though, is in order to get into a Roth IRA, you have to pay taxes now. So you're paying a tax earlier than you have to, maybe on a bigger amount of money, so down the road you get that tax-free benefit. So what does that mean? Well, the first thing is I would hope that hopefully you haven't taken Social Security yet, because if you've taken Social Security, like we talked about earlier in the show, then if you do Roth conversions, you create more taxable income, which means more of your Social Security can be taxed. So often if people are doing Roth conversions, they like to do it before they take Social Security. They like to do it before they come to the age of RMDs. So assuming you just retired, I'm going to assume that that's the case, that you still have an opportunity to do that. And how much do you want to convert? Well, first of all, you're probably not going to do a one big Roth conversion in a year. Almost no one does that. What they do is they plan out over several years between now and the time you have to take Social Security, which is age 70, or you have to take RMDs, which is currently age 73. And they figure out how much they can take out between now and then to put a meaningful dent in that conversion, to take a meaningful amount of that tax-deferred money like the 401k and put it into a tax-free Roth. But also then looking at where different tax brackets kick in, where IRMA kicks in if you're collecting Medicare, and come up with a plan for how much you're going to convert over the next several years, and then try hard to stick to that plan. So it's not going to happen all at once. It's not a one-time thing. It's going to happen over time, ideally. But you need to have a plan, and now would be the time to do it. And you're probably not going to be as diversified according to tax type, as I like to say, as if you started during your working years, but there's still something you can do to make the situation better.
Margaret, thank you so much for calling the Ask Dave hotline and leaving your voicemail. We encourage all of our listeners to call that phone number, and that is 800-822-1111. Leave us a message with your name and number and your question for the show. And if we use your question on the show, we'll make sure you get a free copy of Dave's Amazon bestseller, The Retirement Income Source, the ultimate guide to eternal income. You're listening to The Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we're talking about ways that you can keep more income in your retirement in the form of not overpaying on taxes, right? Not getting hit with that tax time bomb. And Dave, you mentioned in your question for Margaret, our Ask Dave caller, that if her situation was different, if she hadn't just retired in the last year and she maybe had 10 years or so out from retirement, she could have started making that transition from having everything in the 401k or the IRA over to a tax-free investment like the Roth IRA, for example.
She could have started accumulating some things in taxable investments, some things in Roth IRAs, and then if that weren't enough diversification, she could then continue it into retirement. Because the tough part about for Margaret was that when you're doing Roth conversions, they work best. The math works the best financially if you can pay the taxes on the conversion from a different account. And in Margaret's case, if she converts, let's say, $10,000 of an IRA or 401k to a Roth IRA, and the tax is $2,000, she's only going to have $8,000 left to convert, because $2,000 is going to pay the tax. When it works best is you can convert the whole $10,000 and then take the $2,000 tax money and pay that out of a taxable account, like a savings account or a brokerage account or something like that. So if you can start early by diversifying, now you'll have some taxable money. So now if you want to continue those Roth conversions in retirement, they work even better because you have that taxable account from which you can pay the tax. Then you have the tax-free Roth IRA money for a lump sum purchase.
Right, and that's like your big purchase, maybe early in retirement.
Or even buying a car, right? You buy a $50,000 car, you've got to take $70,000, $80,000 out of a 401k to net $50,000. But if you're taking out of a taxable account or a Roth IRA, you just have to withdraw the 50. It's nice and simple.
You just take that 50. You don't have that tax penalty there.
That's right.
Yeah. Well, thank you so much for listening to this episode of the Retirement Income Source, where it's all about the income. We hope we helped you. And if you have any questions, make sure you call that Ask Dave hotline and give us your questions for the show. We love to hear from our listeners. Again, that phone number is 800-822-1111.
And most important, we hope that you're here with us next week, same time, same station. I'm David Scranton here with Sarah Samuels, and you've been listening to the Retirement Income Source, where it's all about the income.